When bonds are sold at a discount, they can be handled with either the straight line method or the effective interest method. We're going to look at the effective interest method. But first, to review, what is the difference, contract to market? If it's the same, the bond is sold at par, but if the contract rate is higher, it sells for a premium price, and if it's lower, it'll sell for a discount price. But why? What drives the price up or down? So you have to think demand for your product on the stock market, and this is the basic way to think of it, although there is more to it. The contract rate, that's the interest that you pay. The market rate is the stock market demand, what the market is willing to pay for your product. What's it worth today? So think principal and interest. That principal is a future one-time payment. What's it worth today? The interest is also a future payment, but these are recurring, that recurring interest annuity. What is that worth today? This is what the bond sells for. So at a basic level, you can think stock market demand, but with bonds, it's different. It's always the present value of future cash flows. But to keep it simple, if you think stock market demand, what price is the market demanding? And that kind of ties into current interest rates. Because depending on the economy and market demands, the Fed may raise or lower interest rates. Bond pricing, in reality, it all has to do with the interest rate. What is the present value of the future cash flow based on that interest rate? So looking at an example, 100,000 5-year bond at 8% compounded semi-annually means N is not 5, it's 10 if it's compounded semi-annually, 10 compounding periods. And interest is always stated annually, so if it's compound semi-annually, you want to use 5. 5% in 6 months plus another 5% in the next 6 months equals that annual rate. So how do we price the bond? As you can see, you take the future cash flows, discount them to what it's worth today, present value of 1 for the one-time principal payment, present value of an annuity, an ordinary annuity, at 7.72173. That's the table value with N of 10, I of 5 with the annuity table. Present value of that interest annuity is $30,887. Add those up. The present value or the selling price of the bond on the stock market is a discount because you're paying less interest than other bonds out there. That's what's going to drive the price down. So your total discount on bonds payable is $7,772. And what do you have to do with this? Well, you have to amortize it. Now, remember, contract determines N, but the market is what's going to determine I. And this is your initial journal entry at the issuance of the bond. Discount on bonds payable is a contra liability, and it has to be removed by the time the bond matures. So you're going to amortize it. Now, in an accounting principles course, usually you're taught the straight line method, a simplified method. In intermediate accounting, you're often taught the effective interest method with a comparison to the straight line, and that is the preferred GAAP method. The straight line is allowed because of the cost effectiveness constraint within GAAP rules. So amortizing with the straight line method, first you just simply take the total, divide it by the compounding periods, and that is how much you will amortize over the life of the bond through interest expense. Notice that the actual cash payment based on the contract rate is $4,000. That will not change. It's written in the contract, the bond indenture. But interest expense is higher, and that means your tax deduction is higher than the actual cash you had to pay. And the normal balance for discount on the bonds payable, that contra liability was a debit, so you amortize it with a credit. Same amount every period over the life of the bond. So this journal entry will be identical using the straight line method. The effective interest method is thought to better follow the matching principle. It accrues actual expenses more accurately based on the current carrying value of the bond. And it better follows accrual accounting. the effective market interest rate of interest multiplied by the outstanding balance of debt. So it's very similar to an amortization table of a note. So the effective interest method are the carrying value initially was $92,278, less than the face value. Face value 100, less the discount, there's your carrying value. The initial selling price is your carrying value. But gradually over time it will increase to the face value because that carrying value must equal the face value at maturity. So you can begin to fill in an amortization table for your 5-year bond. The cash interest will not change. The effective interest rate you're going to use will not change. Market rate of interest is 10, so I must be 5 because this is compounded semi-annually. So you take your carrying value, multiply it by 5, and that is your interest expense, minus the cash payment, and that gives you how much you're going to amortize in the first period. Second period, you're going to amortize a little more. So now look at this amortization table. The discount amortized is gradually going up. Your interest expense also changes year to year. The cash interest paid stays the same. Notice the carrying value has gone from $92,278 in 1 year to $93,536 because it has to equal $100,000 the face value at maturity. And here are your journal entries. The June and the December. Every year it's going to go up. June and December. So that finally, when it matures, the discount has been completely amortized. But notice the discount, the amount amortized is not identical every year as it is with the straight line method. This better follows the matching principle, recording that interest expense more accurately. Total interest expense $47,772, total discount amortized $7,722, and total cash interest paid $40,000. Finally, at maturity, you remove the bonds payable from your books. Key to remember, discount on bonds payable is a contra liability. It decreases the carrying value of the bond, and that discount has to be amortized over the life of the bond. Now, looking at a comparison of contract when contract equals market and contract is less than market. So this is just showing you the numbers and how this comes about. So with the example 100,000 times the table value using N of 10, I of 4, you're paying 8%, market is 8%. There is the present value of 100,000 and the present value of the annuity. So the present value of the bond equals 100,000. This is just proving the numbers. That one on the left is shown as sold at par. The one on the right, contract, if you're paying less, your bond is paying 8%, but market is 10, market is higher, that means there are other bonds out there paying 10%. So to get investors to invest in a bond paying less cash interest, the price must come down. And this is how the number is calculated. You can think of it as market demand, and there is some that plays into that, but in the end it's the present value of future cash flows based on the market rate and compared to the contract rate. When contract equals market, it sells at par. When it's lower, it's sold at a discount.